Hello? Yes, doctor. My pee-pee hurts. My butthole hurts too from all the scammers coming after me on YouTube. They just take me and they ravage me, and I can't take this pain anymore, doctor. Can you help me out, doctor, please?
Welcome back to Strongman Personal Finance. We got to talk about Teladoc stock. Teladoc, my truckers, you know what? Because every time this company posts earnings, you see massive losses. Humongous. That's what she said. Humongous losses on their income statement. And I actually got an email. Somebody was like, Strongman, why does Teladoc have such an insane loss? And I said, you know what? Since I'm a certified CPA accountant, long-term boglehead investor, and author of the book Stop Being a Broke Loser, it's on Amazon. I'm going to tell you why Teladoc had a massive loss, okay? Welcome to a rare morning video, because my wife actually got up in time to watch the kids. Okay. So let's go look at the stock first. So here's the history of Teladoc, okay? You always look at how the stock did previously to judge its future performance. That's how investing works, guys, okay? So we look at Teladoc here, and we can see it was a massive clown bubble. You know, went up enormously during the pandemic. Enormously! This is a 5-year snapshot. And ever since the clown market began to die off, it has gone down pretty significantly. And over 5 years, it's down 23%. It's actually massively underperformed VT, the total world index. What a shock. You know, I thought all these futuristic companies, you would just buy them and then the stock would go up and you would beat boring VT. I guess not, okay? Now, recently, over the past week, Teladoc's down 8.5%. And you can see a drop on earnings, but it's not a significant drop. It's really not. I mean, look at that. It's down 4% after recording a massive, humongous loss. And the question is why? Why did Teladoc have such a huge freaking loss? Well, here's Teladoc Health's fourth quarter and full year 2022 financial results. Fourth quarter revenue grew 15% year over year with the full year of 18%. That's pretty good. 2022 full cash flow from operations and free cash flow. So they have positive cash flow of $189 million. That's good. They have a pretty big cash position of $918 million. Fourth quarter net loss per share of $23.49. That's almost as much as the stock price. In one quarter, you've almost lost on a cash flow, projected future cash flows, discounted, whatever. You've lost almost 100% of the price you paid for the stock. It's pretty freaking nuts, okay? And full year net loss per share of $84.60. Hey, why don't you buy my company for $28.24, and then we will probably lose $84.60 on the income statement. What do you think about that, Mr. Bell? Oh, well, so if I buy the stock for $28, you will lose $84. But can I buy two? Does there a discount if I buy two? Driven by non-cash goodwill impairment charges of $23.26 in the fourth quarter and $83 in the full year. There's your answer right there, ladies and gentlemen. Non-cash goodwill impairment charges. What is goodwill? Let me explain this in very simple terms. Let's say there's a company and all of its I find the value of all its assets minus all of its liabilities to be $50. That's how much the company's worth, okay? On the market. That doesn't even factor in future cash flows, whatever. If I buy the company for $100, I paid $100 for a company that its assets are worth $50. So I paid $50 more than it was worth, quote unquote, right? What is that? What's that all about? That's goodwill. Now, why would you overpay for the fair value of a company's assets? Well, let's say a company has a balance sheet of $50. They just have $50 of cash on the balance sheet, okay? And you look at it and you're like, well, okay, it's worth $50 now, but whoever's running this company is a genius and they're going to make so much money in the future. So maybe that's why you'd overpay for it. I don't know. There's 1,000 different reasons. But goodwill is paying more than a company's worth when you look at it from its assets, its net assets perspective. Okay? That's it. And if you come to find out that the company you bought doesn't live up to what you thought it was going to be, you overpaid. Let's say you buy that company for $50 or it was worth 50, you paid 100. And then you come to find out the CEO is actually a clown and doesn't make any money. Well, that goodwill asset on your balance sheet, that plug, needs to be written down. Why? Because you overpaid and you now realized it. That's it. That's all goodwill is. It's a plug when you pay more than the fair value of a company's net assets. And when the company you bought turns out not to be so great, I think it was Livongo, my hanging dongo. I think Livongo turned out to be a disaster. I think that's what they bought, and they're writing it down. So if we go look at the earnings, right? Negative $3.8 billion loss. $3.8 billion loss on $637 million of revenue. It's goodwill. Now, let's go in the income statement and see if we can take out the goodwill and see what their margins would have been without goodwill, okay? So, if we go to the income statement, quarter ended December 31st, 2022, we could see the goodwill impairment. So, they wrote down almost $4 billion. So, there was an asset, the goodwill asset on their balance sheet was whatever it is now. It's probably almost nothing. They reduced that by $3.7 billion. And to debit an asset, to credit out an asset, you got to debit something. Oh, they debit goodwill impairment loss. Okay. Now, what would their total expenses have been, or what would their total loss from operations have been had they not had goodwill impairment? Well, we take the loss from operations. So I'll zoom in a little bit to show you exactly what I'm talking about. I'm taking this loss from operations right here because that includes the goodwill impairment. So we take negative 3,815,552, and we add back the goodwill impairment to take it out, and we see they still would have had a loss from operations, okay? And there's like some restructuring costs and acquisition costs that are in there, but basically they still would have had a loss from operations. But it doesn't look nearly as bad when you look at it from that perspective, okay? So their margin, this is their adjusted margin, if that's what you want to call it, is negative 8%, okay? So from an operational standpoint, they're very close to profitability, but they're getting hammered by these goodwill impairments. And if we go look at their operating margin previously, let's see if we can do that. Maybe if they had goodwill impairment every quarter, it's going to skew it. Okay, so this was definitely goodwill impairments. Okay, you can definitely see right here. But they had -7 or -11, -7, -11, -15, -18. It seems like their operating losses are narrowing, okay? Because you can go back, look at the history of their operating losses. I mean, obviously those big spikes are them writing down that horrible investment they made. But if that was a one-time mistake and they fixed their crap, I guess they're getting closer to profitability as time goes on. And that doesn't mean you should buy the stock, but they're getting closer to profitability. So they're going to keep getting hammered by goodwill impairment charges, I think. And this is the worry I had. I was like, when you have a company that has a lot of goodwill, this is a real risk, a massive risk. When a company buys another company, you need to look and say, was this a good investment? And that gives you a window into the management's acumen. Because, think about Palantir, okay? They bought a bunch of clown stocks. Now, I don't think they recorded goodwill because they didn't have enough ownership of those companies. But they bought a bunch of garbage, unprofitable garbage. And if you were sitting there and you said, why are they buying these clown stocks? You would have maybe had a window into the management's mindset. Maybe these management guys are clowns. These managers are clowns. They don't know what they're doing. They're buying all these clown stocks. Same thing with Teladoc. Obviously, this was a horrible investment. They spent a massive amount of money on this company, Livongo or whatever it is. And now they figured out, oh my God, this company ain't going to make us jack compared to what we thought they were going to make for us. This is awful. Oh my God. Let's go look at the balance sheet. Now, I don't think Teladoc's going to go out of business, okay? Not even close. And they could potentially at some point become profitable. I definitely can see them becoming profitable at some point. 100%, okay? Why? Well, they have a lot of stock-based compensation, and it seems to be going down year over year. I can see that going away. And actually, their stock-based compensation looks like is the reason if they didn't have any stock-based compensation, they'd be profitable. It's kind of like Palantir, okay? Excluding the goodwill impairments. The goodwill impairments aren't going to last forever. You want to know why? Because at some point, if it goes to zero, what more are you going to impair? You can't impair anything else. But they have positive operating cash flow, okay? They kind of have free cash flow. I guess if you subtract out capital expenditures and capitalized software, they have free cash flow. Obviously, a big part of that is stock-based compensation. And let's see. Let's look at their financing. What are they doing? Stock options exercised, advances from finance companies, proceeds of employee stock plan. So basically, they aren't doing crazy amounts of dilution, at least what I can see here. Okay. They're not issuing tons of shares or going into massive debt. And because they have positive operating cash flow and they can live off that. But obviously, this investment was just an absolute disaster. Let me see if I can find the balance sheet to show you how bad. Okay, so their goodwill balance at the end of December 31st, 2021 was $14.5 billion. Now you can see the goodwill is down to $1 billion from $14 billion. So they overpaid for the fair value of a company's net assets by $14.5 billion. They spent a ton of money on this company they acquired. And now it's been written down because the company they bought, it turns out it's garbage and it's not going to make us any money. They wrote it down to $1 billion. That's a $13.5 billion decrease. That's a lot, okay? But, if you strip that out and just say, okay, yeah, they're clowns. They bought a horrible investment. But is it worth buying now? I don't know. Their loss from operations is narrowing. Goodwill impairments will not last forever because unless they buy another company, then they're freaking clowns. Because eventually you have to write down your goodwill to zero if it turns out the company's worthless. I don't know. I don't know what to think. Let's see. They said they had a 15% year-over-year revenue growth. Yeah, it's slowing down, but they still have revenue growth. But it's definitely slowing down. And then I think, did they give guidance here?
What was their guidance? We're going to 20,000 X in 5 seconds. Trust us, okay?
Let's see. As we look, we see a healthy demand. Let's see. We do 2023. See if it pops up. Guidance, maybe. Guide. Nope. Yeah, I'm sure they gave guidance somewhere, but okay. As the first quarter of 2023, we expect revenue of 610 to 625. Net loss per share of a lot lower. See that? Because they don't have goodwill impairment. Unless they impair goodwill again, and then that would be totally freaking wrong. So between 610 and 625, Q1 2023. So how much growth is that? So we could do 610 divided by 565. So that's 8% revenue growth on the low end year over year. And then on the high end, 625 divided by 565. So between 7 or 8 and 10% revenue growth year over year. So their revenue's definitely slowing down pretty quickly. So their revenue's slowing down. The full year is on the low end 255. What was it this year? 24. Okay, so 2406. Hold on a second. 2550 divided by 2406. Yeah, their revenue's slowing down massively. That's all I'm going to say there. I mean, so they're saying their revenue on the low end is going to grow. If you compare 2023, what they expect to 2022, it's going to grow at 6% on the low end. On the high end, probably like 7 or 8%. Holy crap. So the revenue's massively slowing, and they're still going to have losses from operations. And on top of that, if they have more goodwill impairment charges, these numbers right here are going to be a lot worse. So this is the kind of stock that I would like. Me personally, I would just sit back and just wait. Just wait. Let there be maximum pessimism. Oh, it's dead. Oh, it's garbage. Oh, they've had so many losses because of goodwill. But if I came back and said, hey, the goodwill's gone now. Management, maybe they're not clowns anymore. They're basically profitable now. It could be a possibility to reconsider. But right now, I wouldn't. I personally wouldn't touch this freaking garbage. That's up to you. Do whatever you want, okay? Your choice. All right, quick comments. Hey, Strawman, could you review Jeremy's portfolio from Patreon? He made a video a few days ago. Oh, God. Okay, I'll look at it. Hey, Strongman, would you do a video about Joseph Bubbleson, how M1 Finance is ripping off investors with their automatic equity lending opt-in? Yeah, I could check. Was he like sponsored by them? I think he is. You know less than nothing about stocks. Shirtless fat guy in his mom's basement giving stock advice. Translation, buy Tesla. All right, this has to be a troll. ARK is going to make me more money in a year or two than you've made in your... Yeah, that guy's a troll. Also, what happened to all your funny intros? You never do them anymore. I mean, I still have them. I just need fresh ones. They're old. I've been using them too much. Let's see. I sold all my hymn stock. I think of buying it again. Hymns? Were they losing money? It's amazing that you passed the Series 7. Yeah, it's quite the challenging exam there. 3 people watching. I say 65. What are you talking about? Teladoc will be the AWS of healthcare. Let's see. Morning, Chris. Thoughts on Palantir as a 2030 play? Maybe. I don't know. Not my kind of stock, man. I'm buying VT. You know what I'm saying? Good morning, BB. Good morning, everybody. All right, I got to get to work, but I just wanted to cover Teladoc because apparently they had earnings and they had more goodwill impairments, and that's why it's goodwill impairments. That's why their losses are so bad. Talk to you later. Cheers.